Fundstrat Global Advisors. Tom, it's good to see you. Welcome. You've heard the conversation. Why don't you weigh in? Is it time to get a little more bullish or not?
I think it's time to get bullish. Stocks really have been consolidating for the last couple of months, and I think the conversation you had is correct. You know, the data has not convinced hawks or doves which way inflation's breaking, and I think once we get a decisive data point, and potentially it's tomorrow, I think that $6 trillion of cash comes off the sidelines, and I think stocks break out of this range. And I mean, that's our bet that, you know, May ends up being a very strong month for stocks, even better than it's been already.
What's this rally about? Why don't you tell me in your own words what you think this is about? Why did we rebound so quickly, and why are we now on the doorstep of a new closing high for the S&P?
Well, I think that markets kind of had a very sort of simple framework in their head, which is as soon as inflation accelerates, the Fed switches from dove to hawk and tries to crush the economy. And I think Powell's been very clear in all of his recent statements that, look, inflation is not just this core headline number, and it's not just a services number. It's these three moving pieces: housing, auto insurance, and everything else. And they've been playing a waiting game. We're seeing that even in some of the recent articles, and Powell talked about it, and a lot of folks are talking about auto insurance. I think once that turns, and it possibly, because if you look at PPI, insurance actually rolled over pretty hard. I think it's going to make it clear to markets that it's not just a, hey, inflation is stubborn. It's really this, inflation is now normalizing. The economy's in good shape, and rates are so restrictive, the Fed actually needs to cut rates, and that's actually quite good for stocks. I mean, look, if it's a pause, actually it's good for stocks. If it's a cut, I think it's even better.
I mean, I was looking at the sector activity today, Tom. I mentioned at the top of the program, you know, up volume was way outpacing down. Even earlier today, when it was hard to get much, if anything, going, there was only maybe one or two sectors that were green. Now almost everything is green. You know, tech is having a great session here. That is now, you know, leading the way. A lot of the names there are green. What are we to make of this new closing high for NASDAQ, especially after some of the rollover that we saw, you know, in the month of April in those names?
I think it's really good news. I think a lot of folks thought this was a ninth inning market expansion or, you know, an extended rally, but I think the revival of meme stocks and the fact that there's still a huge amount of cash that's been accumulating on the sidelines in the last couple of weeks shows you, look, I think there's still a lot of legs to this rally. That's why I think May could not only be strong, but of course, as you know, stocks could do very well into year end.
Liz, what do you think?
I still think that we'll struggle at all-time highs. And a couple weeks ago, after the Fed meeting, I got near-term bullish because there was nothing that he came out with and scared us with. And actually, he seemed pretty confident that they were on the right path, and the market interpreted that in a positive way. Now that we're knocking up against new highs with really no positive data behind it, maybe no big negative data, but it's really just been the removal of risks.
Isn't that all that matters? Get those risks out of the way?
To have more multiple expansion at rates with rates that are the same level?
But they're not the same level. They've come down like 25 basis points since the Fed chair spoke at the meeting.
But the Fed funds rate hasn't come down. So the intention to restrict capital activity hasn't come down. And in fact, it stayed where it was longer than we expected it to. So I think we would need incrementally better fundamental news to take us meaningfully higher and have it be durable. I don't doubt that Tom might be right that we would blow through all-time highs and have some more room. I could be wrong about that. I don't know that it'll last very long unless we get better news and things actually look fundamentally better.
Yeah, I think it's going to be about this inflation print tomorrow, whether or not the market tends to rally on from here. I think earnings have been driving the ship for the most part. You've had, 80% of companies outpace expectations, up 8%, which is, been good when you look at the 10-year average. But to Liz's point, we need to see some support from economic data, whether or not this rally is sustainable. I think the cooling labor market data helped out a bit, and earnings coming through to support that. But ultimately, it's going to be sort of like, show me what you got with the CPI print tomorrow. Like, is this consistently sticky inflation, or is this just an anomaly those last 3 months?
Tom, why don't you justify the multiple that the market's trading at? If, look, you could say, well, earnings were good, earnings were better, but a lot of the earnings came from the very top, right? The bulk of the earnings growth came from mega cap. So that's a little misleading. Why do you justify the multiple here? Liz has trouble with it. Why does it make sense to you?
Well, I mean, there's a couple of points to clarify. Number one, the median market multiple is 16 times. So is that demanding when 10-year yields at 4.5% since 1928? Actually, the median multiple should be closer to 20 times for the S&P. In terms of earnings dispersion, or the number of companies producing double-digit earnings growth, it actually hit 47%. It's the highest in over 3 years, which means earnings growth is actually accelerating, and that's with 3 sectors with negative 20% growth: energy, materials, and healthcare. And in terms of price action, I think investors need to be mindful when an index or a stock is bumping up against new highs, and then you layer in a dovish Fed. That's not a bearish setup. That would be extremely bullish. It's going to pull a lot of money off the sidelines. So to me, I think the earnings backdrop's been very good. I think people have been misled by oil rising, thinking that's going to cause another wave of inflation, and it's not. And of course, I think the VIX is telling us, conditions are more risk on than risk off.
What's this meme stock resurgence of this mania part 2? Maybe it's part 3 at this point. I can't even remember. What does that tell us?
I actually think it's healthy. I think it highlights a segment of retail investors that are learning about the stock market. Now, do I think GameStop is a huge buy? I don't have a view on it, nor do I have a view on AMC, but I actually think speculation's healthy, and they're not employing a lot of leverage. So to me, it's just a sign that stocks actually have a revival potentially coming.
What do you guys make of this? Tom says it's good, AJ. What do you say?
No, I think what we're focused on is more quality, and we do like small caps here, but we like companies with more free cash flow. I can't speak on a specific company in particular.
That was a good pivot.
Like that? I learned it from Liz, so I learned it from the best.
Pro Bowl punter. AJ Oden, ladies and gentlemen. But I mean, what it signals, forget about the stock. I don't care about the stocks. I'll care about the signal that here we are in a moment of time again where a photo on social media sends off this frenzy in a pocket of the market that last time this happened made us a little bit uneasy about what the overall message was. So what do you glean from that?
I would say
Over speculate. What you tell me.
Well, I mean, what I would say is that you're always going to have pockets of speculation and, money chasing various investments, but we always try to advise our clients to really kind of keep looking at the long-term investment. When I think about it, I think at the end of the day, it is a positive thing that we're getting more participants in markets, and that's a good thing. When we tell our clients, we like to, they're going to pick names that we're not always going to agree with, but it's important to make sure that your risk appetite is adjusted appropriately. So I think it's a good thing because you're seeing more market participants. That's always positive for markets.
I knew you had something in there. I just had to work on
pull a little bit more.
I knew you had something in there. That was good.
Look, I think it's.
You say it's FOMO. You said it's back
I do think
to
it's a
this
little
fear
FOMO.
of missing out.
But here's why I think it's FOMO, because I think I'm not alone in looking at this recent run up in the market and feeling like, are we getting a little exhausted with it? So investors are now looking for where else can I find this much upside? And we're running out of ideas because there has been so much upside in certain places, and the broadening out trade has provided us with more ideas. So we're still looking for that upside. So the positive about that is that risk appetite is still alive. Investors still want to put money in equities. They're not taking their ball and running home. That is a good thing because we want to see buying activity in the market. But the same risks still exist as they did the first time this happened, or maybe the second time this happened, in the sense that, up 300% in 2 trading days, that's a lot of volatility that I think most investors might not be ready for the timing of, and you want to be careful not to expose yourself too much to something. I don't think anybody really believes that there's a huge fundamental reason that meme stocks have started to take off again since last Friday.
No, I think
we
that's
all understand.
I think that's a
I think we all
fair
understand
statement, Liz.
that this is trading risk, but to make sure that when you're taking trading risk, it could all disappear just as quickly as it was given.
All right, so Tom Lee, this broadening story. Remember, you sat with us at the beginning of the year, said small caps are going to go up 50%. The Russell's not even up 3% year to date, and rates have held it back. I think we can agree on that. As rates come down, Russell goes up. It's leading on the week. It's had a nice month. But what about that call, and where does it go from here?
I think the fundamental backdrop for the Russell 2000 to outperform is actually better today than it was at the start of the year. We have a lot more earnings visibility. You know, the median earnings growth of the Russell 2000 stock is actually about 600 basis points higher than the S&P. So you're getting better earnings growth. And the PE multiple discounts 4 turns on a median. Actually, sorry, it's closer to 6 turns of a discount. So if we're thinking about risk reward, Russell 2000 is going to be a much better place. But as you point out, it really depends on the market being convinced the Fed is dovish. I think once the number of cuts starts to stabilize, that's expected, or even increases, that's really bullish for small caps. And of course, I think it brings money off the sidelines. So I still think it's a 50% move.
What about, you still think it's a 50% move? Standing by that call. What about the broadening story in general? What we've, 1 month, the utilities up 11%. We're talking about utilities now, Tom, as an AI play. I mean, that's where we've come to. Staples are up 5%. I mean, we're rallying towards new highs with defensive type things taking us there. Is there a message in that I need to be aware of?
Yeah, I mean, I think the utilities move checks a couple of boxes. It's rate sensitive, so it could be the market telling us the 10-year could be even lower. It could be defensive, as you're pointing out, which wouldn't be good. Or it's AI, as you point out, which is actually a fact. We know there's a huge power shortage. I still think this is all that indecisive data, but it's actually broadening. And again, to me, at a time when the S&P is near an all-time high, I think investors should really be half full and looking at the totality of this information.
And lastly, before I let you go, we're at session highs, by the way, Tom, as I ask you this last question. And we're looking at the NASDAQ currently at a new record close. So tell me about mega cap. Are you still as big a fan of these stocks as you were?
Yes. I think that anyone who owns mega caps should really put on a 3-year horizon and understand these story arcs behind all these companies. I mean, they're growing prodigiously at a time when GDP growth is 1.6%. These aren't going to lose steam in the next couple of quarters. And whether it's generative AI or cloud consumption or social media or millennials, these are long tail stories. And I think that's why they're going to work for a long time. And these are the best companies basically globally. So they're very, very scarce.
All right. Tom, we'll leave it there. Everybody, I appreciate that. I enjoyed that as we watch this market at record highs. AJ Oden, we'll talk to you soon. Liz Young and Tom Lee, I hope we will as well. By the way, Tom Lee is going to be part of CNBC's Financial Advisors.